Good afternoon, ladies and gentlemen. Welcome back to the 25th November weekly market review. We had a very good market performance last week, and as usual, I will have with me Mr. Gerald Wong, who will break down some of the developments. Gerald?
Hello. Sunny, I think you broke up a bit then. Do you want to redo it? At least on my side.
Okay, redo, Okay, safety thing. Okay, good afternoon, ladies and gentlemen. Welcome back to the 25th November weekly market review. We had a very good market performance last week on the US side, and there are some exciting developments in Singapore as well. And as usual, today I have with me Mr. Gerald Wong, who will be sharing with us some of those developments. How are you, Gerald?
Very good, very good. Now we are approaching the end of November. As we were chatting just now, we see more and more people going for their year-end holidays. I think sentiment is also positive because the financial markets have done fairly well so far this year. So we'll be sharing some of these updates with the participants on the weekly market review today.
Indeed, in the early hours of today, we are just starting our Singapore trading session about 9:30 now. I can see that the US futures is up almost 0.5% across all three major US indices. And also we had the Nvidia earnings last week, which did not seems to impress a Wall Street expectation. Hence, we also saw some rotation, the continuation of this trend where investors are rotating out of tech stocks and into more economic sensitive sectors like financials and industrial names. And of course, on the Singapore side, we also saw the STI at a 17-year high. And with that, we also saw the Singapore Exchange, SGX, hitting its all-time high. Also, I believe you will cover some of these developments with us today, right, Gerald?
That's right. Yes. Before we start, the usual disclaimer that the sharing is for information purposes only and should not be taken to be financial advice. We have one final Ask SIAS for this year on the 11th of December. So if you're not away on holiday on the 11th of December, do join us for the upcoming session. And you can scan this QR code to register. If you find the weekly market review helpful, do leave us a review on Google. And if you are keen to join SIAS as a member, where you'll be able to access various online resources as well as investor education programs, you can go to the website sias.org.sg/membership or scan the QR code to join as a member. Okay, so as Sunny mentioned earlier, we saw a rebound in the US stocks following last week's decline. This is something that is fairly broad-based across S&P 500, which is once again back to the 6,000 levels. No major US economic data out last week, but in Singapore, we saw quite a number of significant developments. Most importantly, we had our Singapore GDP growth numbers being released. For the third quarter of 2024, Singapore's economy grew by 5.4% compared to the previous year, and this is an upward revision compared to the initial forecast. So what we can see from this chart is that on a year-on-year basis, the momentum for the economic growth appears to be picking up, where we see stronger year-on-year growth over the past few quarters. Okay, so that is something that is positive. And with that, the Ministry of Trade and Industry has actually raised Singapore's GDP growth forecast for 2024 to about 3.5% from previously in the range of 2 to 3%. Okay, so this is what we see in terms of the growth expectations. Like I mentioned earlier, over the past few quarters, we have seen improving momentum for the economic growth. Last year, Singapore's GDP grew by 1.1%. This year, the MTI is expecting it to grow by 3.5%. And next year, the MTI expects Singapore's economy to grow by 1 to 3%. Okay. So the Singapore economy has done fairly well this year because the global growth has been fairly resilient. What we also saw last week, and this is probably something that many viewers who are looking at income portfolio might be interested in. The Singapore T-bill yield actually rebounded slightly. We are now back to above the 3% level. So the increase in US government bond yield has actually led to a slight bounce in the Singapore 6-month T-bill cut-off yield as well, which is now at 3.08%. Okay, so in terms of the performance of the STI, we saw the SGX actually reaching a 17-year high in terms of the share price, with a 12% bounce in the past week. Part of the sentiment is really driven by the strong performance of the STI, and how that may potentially lead to an increase in the equities traded value on the SGX. Outside of the SGX, in terms of what have then not been doing as well, we saw quite a number of REITs continuing to pull back. As I mentioned earlier, we saw the bounce in the 6-month Singapore T-bill yield. And with the general increase in bond yields that we have seen, that has actually put pressure on the share prices of Singapore REITs. At the same time, what we have seen for the Singapore REITs is that there have been quite a number of corporate transactions that have been announced, and I'll be going through some of this later on. Okay, so in terms of the performance of the Singapore REITs, we see the REITs with US office assets having a bit of a bounce last week following the weakness in the preceding weeks. And then what we see in terms of the top losers would be some of the REITs with the emerging market exposure, such as in Indonesia, because of concerns about the weakness in currency, given the strength in the US dollar we have seen over the past few weeks. Okay, so I will start by talking about Keppel DC REIT, which announced a very big transaction last week, and had many questions around how should we think about the transaction and what is the potential impact. Okay, so Keppel DC REIT, if you look at the share price, it has bounced considerably since April this year. Because of the improved sentiment towards the tech sector, because of the structural growth that is coming through from data centers. So following the strong momentum, we have seen actually Keppel DC REIT closing at $2.22 on Friday. Okay, so what Keppel DC REIT announced would be the acquisition of 2 data centers in Singapore, KDC SGP7, KDC SGP8. They are both AI-ready data centers, and this will be purchased from its sponsor. Okay, in terms of the total acquisition cost, estimated to be at about 1.067 billion. So this is actually a fairly sizable transaction that will enable Keppel DC REIT to entrench its position within the Singapore data center market. Okay, so this is a picture of the 2 data centers located in Singapore. Like I mentioned earlier, they are actually AI ready. And in terms of the rationale for the transaction, there were a few that were suggested. So effectively, this is a strategic addition to its portfolio, and being able to increase the exposure in Singapore, which is Asia's top data center hub. It is expected to lead to an increase in the distribution per unit. And with the exposure that the data centers have, the manager believes that there are several levers that they can use to be able to drive further growth as well as rental uplift. And following the equity fundraising that has been announced, the manager believes that it will be able to create a stronger platform to be able to drive long-term growth. Okay, so in terms of the assets under management of Keppel DC REIT, currently at 3.9 billion, of which Singapore makes up about 51%, representing 2.1 billion AUM. Okay, following the transaction, given that it is a very sizable portfolio, the Singapore AUM is expected to grow to 3.4 billion. and that represents a 67% increase. Okay, that will bring Keppel DC REIT's overall portfolio to 5.2 billion, which is a sizable increase compared to its current portfolio. Okay, in terms of the impact to the distribution per unit, okay, this is where I wanted to spend a bit more time to explain the different impact. Okay, so as an immediate basis, the acquisition is expected to be accretive to DPU by 11.1%. Okay, so a fairly sizable accretion to the DPU. But there is a scenario where we have another DPU accretion number to think about. Okay, so there is actually a potential for the land lease to be extended by another 10 years. Okay, if this were to come true, Keppel DC REIT would have to make an additional payment to the sponsor as well as to JTC. But then with this, they will be able to enjoy a few additional benefits, including being able to enjoy the cash flow over a longer period, as well as a potential capital value uplift in the longer term. So in this scenario where there is an additional extension of the land lease for 10 years, then the DPU accretion that we are looking at would be 8.1%. Okay. How will this acquisition be funded? If there is the lease extension for the consideration of 350 million, then effectively what we are looking at would be the total purchase consideration to be 1.386 billion. Okay, there will be some other acquisition related expenses. So the total acquisition cost will be at about 1.44 billion. Okay, based on what the management have shared, 70% of this will be funded through equity and 30% of it through debt. And this is where they have already announced an equity fundraising to be able to finance the acquisition of this asset. Okay, in terms of the valuation that Keppel DC REIT is now trading at, if you look at the dividend yield, 4.1%, which is below the historical average, and from a price to book basis, 1.61 times price to book, which is above the historical average. Okay, next we have got Keppel Infrastructure Trust, also another entity that is partly owned by Keppel Limited and also announced an acquisition last week. But compared to what we see for Keppel DC REIT, where there has been fairly strong price momentum, Keppel Infrastructure Trust share price has not actually rebounded as much and was at 44 cents as of last Friday. Okay, so the acquisition is actually for this desalination plant in Singapore, the Marina East Desalination Plant, which is Singapore's fourth desalination plant. Okay, it has a capacity of 137,000 cubic meters per day. The plant commenced operations in June 2020 and has a 25-year concession until June 2045. Okay, in terms of the impact of this acquisition, once again, the manager expects that the acquisition will be accretive to unit holders. It will increase Keppel Infrastructure Trust exposure to water treatment solutions in Singapore. And the manager believes that this is a high quality and energy efficient asset. Okay, so in terms of how Keppel Infrastructure Trust portfolio will shift following this acquisition, the asset under management will grow to 9 billion from 8.7 billion currently. And if you're to look at the breakdown of the portfolio, the Keppel Marina East Desalination Plant will make up about 4% of its 9 billion portfolio. Okay. If we're to look at the breakdown by geography, Singapore will represent about 22% of its 9 billion portfolio, with the contribution from Keppel Marina East Desalination Plant. And then you've got other key markets, including Australia, New Zealand, and other countries, as well as Saudi Arabia, each representing about 25%. Okay, so in terms of the timeline of the acquisition by Keppel Infrastructure Trust, there will be an EGM that will be held for unit holders to vote for the transaction, given that it is an interested party transaction, and the details of the EGM will be announced shortly. Okay, so what you might have noticed is that both of these acquisitions come through from Keppel related entities, and it involves Keppel Limited actually selling off some of their assets to their REITs and business trust. This is actually part of Keppel's Vision 2030 target to be able to grow its fund under management to 200 billion. So what we do see would be the active capital recycling, where it actually recycles some of the assets in its portfolio, but still be able to grow its fund management fees as part of the entire capital asset allocation strategy. Okay, so in terms of the fund under management for Keppel Limited, at the end of June 2024, 85 billion. They target to grow that to 100 billion by 2026 and 200 billion by 2030. So some of the initiatives that will help to drive this will be through the launch of new funds, scaling up existing flagship products, and then in terms of the listed entities, including Keppel DC REIT, Keppel Infrastructure Trust, be able to grow their portfolios and be able to earn a higher fund management fees through these listed entities. Okay, so in terms of what to look out for in the week ahead, we have the closing for applications for the Singapore Savings Bond. It is a light week for the US market, given that we have a holiday that's coming up. But just before that, we have the US economic data that will be released. Okay, so with that, I'll hand over to Sunny, who will share with us the technical analysis.
Okay, thanks, Gerald, for that updates on some of the developments in the Singapore market. So on the STI index, I'm seeing that this morning we also see a healthy bit of a jump up 0.3% or 11 points. We are now at 3,757 points at around the 10 a.m. Timing. Okay, so not much of a change on the STI index. Of course, the jump in SGX share price, as well as some of the banks that you can see in this early trade, also push, also sort of not saying push the STI higher, but maintain the STI at a elevated level, which is close to the year-to-date high as well at 3,766 points. So I think looking at the indicators of the STI, is not looking positive, and I don't see that it is looking at a breakout coming up very soon. So you can see that in the past 5 trading session, according to the MACD indicator, the STI is actually sort of the uptrend momentum is sort of subsiding, and you see a converging of the MACD line towards the signal line, which could, if a crossover happen, could signal a change in direction of the STI index to pull back towards the mean or the 20 days moving average, which is also the Bollinger Band basis, now at the 3,678 points level. My preferred level of accumulating on the STI index is still somewhere close to the 50 days moving average. And from last week, when I put this area, this gray highlighted area over here, the 50 days moving average has shifted up to the 3,625 points level. So let me just make this adjustment. Okay, so we are still looking at the 3,625 points level to get to calculate further on the STI index, and this is a strategy that we are reporting for next year as well. Okay, so no hurry, no need to FOMO to miss out on the recent rally that we see, but wait for the markets to come back to the 50 days moving average, just like what we saw in early part of November, and that could give you a better entry price on the STI index. The RSI is also looking very toppish right now. The latest reading at 68, 2 points away from the 70-point overbought mark. and hence it could be also poised for a retracement once it's hit that level. Okay, so a scenario that we see is during the September period where we see the RSI hit a high of about 79 points, and you can see that the SIAS starts to consolidate back towards the 20 days moving average at least. So this is the pattern that I'm setting up for. I'm looking to see on the SCI index before I get back into accumulate for the year of 2025. Next, let's move to the US indices. So you can see Dow Jones Index was the big winner last week. Gerald shared earlier that the Dow Jones Index jumped about 2% for the week, and much of those gains came on Friday, which we jumped about 426 points or close to 1% for the Dow Jones Index to close at the 44,296 points. The year-to-date high or the all-time high is now at 44,486 points. I think, yes, we have a chance to test that level again, but how much upside do we have from there? I am not very confident given the short trading week this week on Thanksgiving and Black Friday, and of course the holiday coming up in December. I think the Dow Jones Index will likely end around the 44,500 level. Okay, so same thing for the Dow Jones Index. I'm looking at this gray area highlighted over here because the Dow Jones Index, because of the shift in trend from technology to a more economic sensitive sector like industrial and financials, I think the Dow Jones Index will likely use the 20 days moving average as a bounce. And of course, if it could move to the 50 days moving average, that would be a bonus. So I think for people looking at the Dow Jones Index, which are the top 30 stocks in the US market, you can reference the 20 days moving average at 43,181 points, or even the 50 days moving average at 42,655 points for a accumulation level for the Dow Jones Index, positioning your portfolio for next year as well. Okay, the indicators wise, I think MACD is just showing us that the index is very toppish right now, and it is crisscrossing here, so there's not a clear indication of any direction according to the MACD indicator that the Dow Jones Index will be moving. And on the RSI, we had a strong momentum reading at 65 as of close of last Friday, which is above the 14 days RSI moving average of 61 and approaching the 70-point mark, which is the overbought level, and that is where we could see some kind of retracement on the Dow Jones Index. Okay. Next, let's move to the broader index. So S&P 500, like the Nasdaq Composite, gained about 1.7% last week, and on Friday it rose about 0.35%. So you can see that S&P 500 also have a nice bounce over here, led by the industrial sector. Actually, all of the sector on the S&P 500 rose on Friday, except for the tech and communication sector, which I believe the pullback was partly due to NVIDIA earnings, which did not really impress investors. Okay, so for the S&P 500, the all-time high is at 6,017 points. So the current level that we are at now, about 5,970 points, is about 40 to 50 points away. So yes, we have a chance to test that level again, but then anything above that would likely be a challenge for the S&P 500. So the 6,000 level is where we are looking at the S&P 500 finishing at the end of the year. So the indicator wise, you can see that MACD is a toppish, slightly negative reading. So not really giving us any kind of direction here, but likely going to be sort of a range bound, I would say, with the upper bound on the on the all-time high. The RSI at 61 reading is close to the 14 days RSI moving average. So there is still some positive momentum in the S&P 500 index now, and that could also be one of the factors that could push the S&P 500 slightly higher, but I don't see it breaking the or sort of have a very significant break above the year-to-date high at 6,017 points. Accumulation levels, same thing, looking at the 50 days moving average, which is the blue line that you see here. That's the exponential moving average level, now at 5,806 points. So 5,800 is where I would take in the S&P 500 again to position my portfolio for next year. Lastly, let's move to the Nasdaq Composite Index. So on the Nasdaq Composite Index, you can see that last Friday, NVIDIA actually dropped about 3%. So thereby sort of erasing much of the gains for this week for NVIDIA share price. So the results came out, which was fantastic. It met analyst expectations. It doubled its revenue. So I think the NVIDIA share price will continue to grow going forward. but definitely not at the pace that we see in the past 1 or 2 years. Okay, so on the Nasdaq Composite Index first, all-time high is at 19,366 points over here, and now we are at the 19,000 handle, 3 points above the 19,000 handle. And according to the indicators, MACD is already showing a sign that we may see some kind of pullback, and the direction is negative. The momentum is negative right now. The RSI reading you can see for the past few trading sessions, at least past 4 or 5 trading sessions, it has been relatively flat and kept below the 14 days RSI moving average reading of 60 points. So not much of a momentum we are experiencing according to the indicators here on the Nasdaq Composite Index. Partly also we see a continuation of the trends that investors are rotating out of the tech stocks to the more economic sensitive sector. So one of the strategy that I'm thinking of for 2025 would be to narrow down on certain stocks that we are looking at. So much of this year, we look at the Magnificent Seven stocks, okay, the top seven tech stocks in US. So probably next year, besides allocating some of our funds to the major US indices, we would also need to focus on some of the more prominent names in the Magnificent Seven, which I'm still studying and researching on it. Probably will narrow it down to the Fabulous Five or the Fantastic Four, which is the top 4 or 5 counters among the Max 7, to sort of a overweight on our portfolio going to next year, thereby would likely to enhance the gains that we see to outperform the indices. Okay, so looking forward to share that with you going into December, where we sort of readjust our portfolio. And Gerald, anything to add before the Thanksgiving holiday? I heard you have a webinar coming up.
Yes, we do have a webinar coming up on Singapore REITs. It is something that we have had quite a number of questions from different investors on, given that the REIT share prices have actually corrected in the past few weeks, even with the Federal Reserve interest rate cuts. So if I were to look at index of Singapore REITs at this point in time, actually it is just about 5% away from its lows before the Fed actually started cutting the interest rates. So I think it might be helpful to just do a recap around where are we for Singapore REITs at this point in time and what to look out for going to 2025.
Yes, definitely. A lot of Singaporean investors are very interested in the REITs, and the recent sort of a sticky inflation situation led to interest rate could be staying higher for even longer, and a lot of concerns on REITs investors. So if you have if you like to get some insights on how the REITs will perform going into next year, 2025, then you can go to the Sprout website to look out for the link to sign up for the REITs webinar. Okay, and I think this is the time that we have for this weekly market review. In the meantime, trade safe and stay safe, and we'll see you again next Monday on the next weekly market review. Goodbye.
Thank you.